We're now going to go over the income statement, one of the most important financial statements you can look at on a monthly basis. The income statement summarizes the revenue, costs, and expenses incurred during a specific period of time. Here is a sample income statement. As you can see, it starts with net revenue less cost of goods sold equals the gross profit. Then you sum up your expenses, so gross profit less expenses equals net income. Just to summarize the income statement equation, that is net revenue less cost of goods sold equals gross profit. Now you have the gross profit, you subtract expenses, and that gives you net income. The income statement is also known as the profit and loss statement, or P&L. Don't be fooled when somebody refers to the income statement as one of these other names. The first part of the income statement is revenue. Revenue is the amount of money a company receives during a specific period. This includes discounts and deductions for returned merchandise. Revenue is also called top line or gross income. Cost of goods sold, or COGS, are the direct costs attributable to the production of the goods sold by a company. For example, cost of materials used in creating the goods and direct labor costs. COGS does not include indirect expenses such as distribution, sales, or marketing expenses. Cost of goods sold sits just below net revenue on the income statement. Cost of goods sold is very important to track as it gives you a sense of your margins and what products are most profitable for you to produce. Gross profit equals revenue less cost of goods sold. To hammer this equation home, you can see on the income statement that net revenue less cost of goods sold equals gross profit. The gross profit margin is a very important metric to track. Typically, a higher gross profit margin is better, but in reality, the gross profit margins vary by industry. So when you're trying to compare whether or not you have a good gross profit margin, you want to compare to other companies in the same industry. The equation for the gross profit margin is gross profit divided by revenue. Most people know what expenses are, but for purposes of defining everything on the income statement, an expense is a cost a business incurs during a specific period. Net revenue equals revenue less cost of goods sold less expenses. When you're looking at net revenue, that allows you to track how much money you're either making each month or losing each month. When a company wants to get to break even, that means that they're not making or losing money, which means that the net revenue is zero. To hammer this equation home, you can see on the sample income statement that net revenue less cost of goods sold equals gross profit. Now you have gross profit less total expenses equals net income. I hope everybody now has that equation solidified in their heads. Now that we've gone over the income statement, I thought I'd give you a quiz to make sure that things have really sunk in. The first question is, net income equals blank minus blank minus blank. The second question is, if you made $1,000 from consulting revenue and spent $300 on travel expenses and had no other costs or expenses, what is your net income? The answers are net income equals revenue less cost of goods sold less expenses. The second question is, if you made $1,000 from consulting revenue and spent $300 on travel expenses and had no other costs or expenses, what is your net income? Your net income would be $700. Thanks for going over the income statement with me. Next up, we are going to go over the balance sheet.